Hello everyone, this is Chris Martinson of Peak Prosperity with a special video report for you. It is May 2017, and what I want to talk to you about is the Federal Reserve and how they're ripping off the American taxpayers, again, with Congress's approval at first, but Congress seems to be uncomfortable with this right now. And what I'm talking about, were you aware that the Federal Reserve, instead of remitting over $10 billion to the U.S. government treasury, to go for things that we could build in the United States, instead remitted those $10 billion increments over to foreign banks? What? Why is the Federal Reserve printing money out of thin air and then handing it over to foreign banks? Well, let's talk about it. What I'm going to do is pull up here this first article so you can see the headline. And this is titled, "Big Winners as Fed Raises Rates, Foreign Banks." What? This is a 2015 article, by the way. Units of foreign banks this year received nearly half of the roughly $6.25 billion in interest the Fed paid banks on money called reserves they park with the Fed. That's interesting. What is going on here? So let's go now to the first chart in this. We have to get a couple of definitions out of the way. Hold on, before we go to that chart. Here's what the process is supposed to be. The process is supposed to be that when the Fed wants to raise rates, you heard about it before, the FOMC, they meet, and are they going to raise rates? And everybody, oh my gosh, that's a big thing. And a lot of people mistakenly think that the Fed raises rates by announcing it, like it's going to be 1% now as the new rate of interest. That's not how it works. There's a little mechanism. Stick with me. It's worth knowing because now you'll understand what's happening when they're paying foreign banks. Here's how the Fed raises rates. There's a rate of interest that exists between banks as banks loan each other money, overnight typically, so that Bank A has money, Bank B needs money. Why does Bank B need money? Because every day they have to have a certain amount of cash reserves to match their assets and liabilities. So there's a balancing act there, and sometimes Bank B needs some money, so they borrow it. The way the Fed raises rates is they will go into the market and they'll take cash away from Bank A, and now Bank A has less cash to lend, so now they're going to charge a slightly higher rate of interest on that. So it works like this. Interest rates go up as the Fed takes money or cash out of the system. Interest rates go down as the Fed floods the market with cash. That's supposed to be how it works. And the Fed now is desperately afraid to pull cash out of the system. Why? Because if they do that, these elevated stock markets will go crashing to earth and all of that. Remember, in the first 4 months of 2017, central banks across the world added over $1 trillion of new money into the system. They're scared like crazy to pull money back out. But the Fed politically says they have to raise rates. What do? Here's where the story gets really fascinating, so follow along. The first is, we're going to look at this chart now. This is excess reserves of depository institutions or banks, and you'll notice it was nothing, 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 and then there in 2008 it vaults upwards and goes higher and higher, goes over 2.5 trillion. It's still over 2 trillion. Now, why is that a big number? 2 trillion of excess reserves held at the Fed. Where did the banks get 2 trillion in excess reserves? I'm glad you asked. They got it because the Fed printed the money up and they handed it back out into the markets, and it ended up at the banks, and then they put it back at the Fed, and now the Fed pays interest on that. Let's go to the second chart in this story. Now what you're looking at, this is the interest rate on excess reserves, called the IOER, the interest rate on excess reserves. Look at that. It was pretty much, this chart only goes back to 2011, but if you went before the crisis, the number was 0 because the Fed never had the authority to pay interest to banks who are parking money with the Fed as they're required to do after the Fed printed the money and handed it to them. So notice here that what we see is that Fed is now paying 1% to banks on those excess reserves. Let's do some simple math. $2 trillion times 1% is 20 billion. $20 billion a year is being given to banks for the interest on their excess reserves. That number used to be 0 before the crisis. Now it's 20 billion, and that is risk-free money. So let's follow along for a second. What would you get if you loaned your money to one of these same big banks? Let's call it a certificate of deposit. What would you get? Well, typically you'd get 0.05%, not 5%, 0.05%. So Bank of America might get 1% for holding money at the Fed, but pay you 0.05% for money you give to it. So they're going to get a 20-to-1 return because you loan $1,000 to Bank of America as part of a certificate of deposit. They turn around and park that back at the Fed, and they get 1% on it, and they're making 20 times what you're making on your money. Risk-free, by the way. You still have risk in your certificate of deposit because Bank of America has enormous derivative exposures, and they've enshrined bail-in procedures and all these other reasons. So stick with me for a second because those $2 trillion in excess reserves are really just part of the story. We're going to go now to the third chart. Here we're looking actually that the $2 trillion is excess reserves of domestic banks, but look, there's another $1 trillion of foreign banks. These are foreign banks who are parking their money at the Federal Reserve. Why? Because they're getting 1% for their money. You can't get that back home. They have about $1 trillion at the Fed, and that means they're getting about $10 billion a year. Now, normally what happens, the Fed has this huge balance sheet. It consists of things like mortgage-backed securities, almost $1.75 trillion of those, treasury securities, all adding up to about $4 trillion, $4.5 trillion. They get interest on that, and that interest is supposed to go back to the U.S. Treasury, less expenses. Well, paying interest is an expense. So because that $10 billion went to foreign banks, it didn't go to the U.S. taxpayer. And so here's an article came out in March this year from The Economist. And there's a number of interesting things here. First, they say that over a decade ago, Congress authorized the Fed to pay interest on funds in excess of those banks need to meet reserve requirements. So this is, Congress authorized it. And then later they say Congress is really upset with this practice. Of course they are, but they authorized it. So shut up, Congress. Here's an interesting part. As rates rise, that is, as the Fed pays more and more and more to excess reserves, the cost of paying interest on them will climb to $27 billion this year, according to Fed projections, and $50 billion by 2019. $50 billion going to banks simply for holding money back at the Fed that the Fed gave to them in the first place. Are you following this story? It's really unpleasant, and it's deeply unfair. And when you think about the $1 trillion of interest that didn't go to U.S. savers, who can no longer put that back into helping their children put a down payment down on a house or start a business. You want to know why all those things are falling off a cliff is because the banks have decided we get zero, but they've made for themselves a really tasty deal of getting 20 times the same amount of interest they're offering to us from the Federal Reserve. So the Economist article ends this way. Meddling with the arrangement of paying interest on excess reserves might cost even more, because without these, banks would try and lend their excess reserves to each other, so short-term interest rates would collapse. So to keep control of monetary policy and avert a surge in inflation, the Fed would have to sell assets rapidly to withdraw reserves from the system. That's fancy talk. Let me decode that. Without pushing all the money into the system to keep the markets elevated, by conducting monetary policy as it has for the first 100 years of its existence, the Federal Reserve would risk collapsing the house of cards they've created by inflating our financial asset markets, making the rich even richer, creating the largest class division ever, putting our entire monetary history at risk, putting our entire currency at risk, doing all of that simply so they can avoid having their main clients, which are the large banks, suffer a slightly worse year of profits this year than before. Because that's what that $26 billion going from the Fed to the big banks is, pure profit without any risk. Do you know how many businesses are capable of generating 20 or more billion dollars of profits without taking any risk whatsoever? This many. Double goose eggs on that one. So that's a story people need to know about it because it's outrageous. It is fundamentally wrong. It is unfair. It is anti-American. It's anti-human. It's just wrong. Banks should not be given money printed out of thin air because that unjustly rewards them in the first place and it hurts you in the second place because it means your savings are worth less over time. So with that, I'm Chris Martinson. I hope you enjoyed this. We're going to keep explaining these things as they come up because knowing what's going on in the world will help you take the right actions. Thank you for listening.